This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our July 12th, 2023 edition. I'm Justin Klein, and I'm here today to help you become a better investor. Like always, it's a constant endeavor. You always have to improve if you are not staying on top of the current trends, the current environment, and even sometimes, the current vernacular. Then you're going to follow behind the times. And, being good at anything means consistent work, sharpening your tool belt. And in this line of work, or in this endeavor, it's about making the most of your time and your capital. And that's what we are here to do. Help you eliminate the counterproductive habits that we all make, right? We all do things that we regret. We're humans. We're not perfect. And we do things like let emotions influence our decision-making process. We chase headlines and take tips and oftentimes take the easy way out, or what we feel is the easy way out. And, I've been doing this for over 20 years, and nothing about this is easy. Now, there's ways to make it easier, but it'll never just be easy. So, there's the old saying, you can chase returns, but you'll never catch them. And that's one way that you can eliminate those counterproductive habits, is by not chasing returns. And there's a million other ways. So we're going to dig into all of this today and give you my unbiased perspective and data developed by more than 20 years of investment experience, like I said. And it's all about answering your questions and helping you take that next step in your journey, your quest to achieve financial freedom. And the phone lines are open, ready for you at 888-99-CHART. Now, my focus point today looks in the story behind this question. Is it good news for investors if rates stay higher for longer? Bond prices going down, rates going up. Does that mean opportunity? You know how in history of asset prices, when things go down, people get scared, they run. Fear of more losses, right? That emotion. But let's step back and look at where rates are, where they're likely headed, both short, medium, and long term. And that can inform you on how to shift your portfolio and how to think about duration risk. And oftentimes that is very important, whether you're investing in stocks, whether you're investing in bonds, whatever it is. There are different types of risk that you're going to be exposed to, and duration risk is one of them, typically no matter what asset class you are looking at. Okay. Now, time permitted, I want to dig into some other stories. One is in regards to this negotiation in regards to a negotiation when it comes to taxing companies across borders. And the current laws are made for a time when, if you wanted to enter into business in another country, oftentimes you had to import a significant amount of goods. You have to set up distribution centers, a lot of infrastructure, maybe even factories in those other countries. Nowadays, and especially in technology, you don't have to do that. You can access a population without much investment in that particular country. And therefore, you're making money off of another country's citizens, but you're not giving anything back to those countries. So for a long time, since really the start of the financial crisis, governments have trying to figure out how to deal with this. And this is going to have ramifications if it does pass. So we're going to look at that. Also, how are ETFs constructed? I want to give you a quick example of something that kind of doesn't make sense and what skews some of these broad indices, and you need to be aware of that. And on top of the trends and the often misleading titles that many of these mutual funds, ETFs tend to have. Also, we're going to look at the AI revolution, and we know that NVIDIA is the top dog right now, but what companies are coming for their throats? And there's always, in almost every industry, coming out the top dog, and we're going to look at that. We also have some voice bank questions. One is on SBSW and the other WP Carey. So this is all planned for this episode of InvestTalk, and of course, your live calls, most importantly, at 888-99-CHART. Let's take a quick look at the market today. We had inflation data, and I've been saying this for a while. Inflation is going to decelerate for pretty much the entire year, but you're going to get a stair step lower in the month of June simply because of base effects, meaning the month-over-month data peaked in June of last year, and therefore that was, when you're looking as a whole, you're looking at the highest rate of change number that you're calculating off, and so it made this go all the way down. The CPI go all the way down to 3%. You still have core CPI about 4.3%. That's probably going to take a stair step down in September, October timeframe. So we still have a couple months more of a little bit elevated core CPI, and that probably means the Fed could still raise another one more time. But what really this did was it took, I don't want to say it took off the table, but it made it less likely the Fed is going to do 2 more rate hikes, which they've been talking about. It didn't really change the odds of a Fed rate hike in 2 weeks from now, in the end of July. But the September meeting, that came down markedly. So that's why the market was strong. The dollar was down pretty good. Gold was up nicely. You had yields fall. All the recent hawkish talk was kind of walked back a bit in the markets, and that's why you saw an up day. All right, so that was the market today, and we'll see what we get tomorrow, if we get any follow through, or is that kind of that blow off little top near term? That's potential as well. All right, let's pivot over to our first voice bank question now.
Hey, Justin or Steve, I was calling to get your thoughts on Bank of Hawaii, ticker BOH. I know it's come down quite a bit because of the banking crisis. Pays a pretty good dividend. I was just seeing what your thoughts were to get in now and kind of go from there. Looking forward to hearing your thoughts. Thanks. Bye.
All right, let's once again back up. You're looking at that 6% dividend, and based on earnings, it can pay it. The issue with all of these regional banks, and yes, this would be considered a regional bank, even if it's not an entire region, it's just one state of Hawaii. They have assets that are being hurt by duration risk or rising interest rates. And so, there's a lot of skeletons in the closet when it comes to these regional banks, and it's very difficult to know exactly which one will be the subject of the next run on the bank, whose deposits are truly sticky. It's pretty, I wouldn't say it's easy, but banks can paper over deposit loss by doing very short-term measures. But longer term, it's more difficult to maintain profitability and keep that deposit base if it's not super sticky. The large banks, the Bank of Americas of the world, for example, their almost entire deposit base is insured, meaning it's below that 250,000 mark, because it's the average day person that might only have a few $1,000s in the bank at any given time. We're living paycheck to paycheck. Whereas Silicon Valley Bank, a lot more of that was uninsured. 90+% was uninsured, over the 250,000 mark. And so a lot of these regional banks, it's all about the stickiness of that deposit base. And as interest rates continue to go up, short-term rates over 5%, 5.5% on some parts of the curve, it becomes attractive to pull those deposits out. And so I don't find these regional banks to be particularly attractive. Yes, some of them can be taken out, but probably more in a distressed situation than an advantageous situation. And if there is It doesn't have to be Bank of Hawaii in this case. It could be another regional bank that has earnings season, right? It has an earnings report. We're in earnings season now that sheds more light on whether the deposits are staying or leaving. And it only takes one or two to start the redux of the crisis in the spring. And then it will spread to these regional banks. And I think that's why I don't find them particularly attractive. And that's why you're looking at the earnings, you're looking at that dividend. That's not how you view these regional banks at this point. You would really have to dig into their asset base, understand what type of unrealized losses there are on their portfolio, what the duration of that portfolio looks like, and whether or not that is making them technically insolvent. And for a lot of these names, they are. So I'm passing on almost all the regional banks unless I have a very good grasp that their deposit base is extremely sticky and their unrealized losses are minor. Now, as we head into a break, let me tell you about the new video feature we are producing. It's called the InvestTalk Sector Spotlight. It's free now on YouTube, and the first episode talks about the technology sector and its rapid innovation. We talk about AI and blockchain, cloud computing, and software as a service. The InvestTalk Sector Spotlight, you can find that right now over on our YouTube channel. Now, my phone lines are open, waiting for your questions at 888-99-CHART.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward?
I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Foods, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART. Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Let's go to Art in Menlo Park, looking at FedEx. How you doing, Art?
Good, Justin. How are you today?
Doing great. Do you want to buy FedEx, or do you own it?
I own it, but I'm actually thinking about liquidating some of it because I've had it for several years now, and I've made a nice little profit. Mm-hmm. I was thinking about maybe selling about half at this point because I'm thinking that their international business is not what it was prior to the last couple of years when before the COVID. Mm-hmm. And from what I hear, China is like they're still not really back to where they were previous. So I'm just thinking that the international part of their business is not going to be as robust.
Yeah, that's certainly true. It's a global company, and when the global economy slows, then they feel it. And it's not just about here in the U.S. And you've seen that as of late, earnings are declining for the last 4 quarters, down from $20.61 in 2022, supposed to make about $15 per share this year. And estimates for the next 2 years are actually coming down, are being downgraded by analysts. But the stock has rallied. Its relative strength is pretty strong, right at 89. So, this is more of our value. Let's just go backwards. Our value is closer to about $200 per share, and now it's at $261. So I do think this is you're thinking along the right lines. Do I trim it? Do I eliminate it completely? I do think you should be trimming it probably pretty soon. Okay. Now, what I will say is technically there's not major resistance till about 280, and now it's at 261. So It depends how cute you want to get. It may get to 280, it may not. But the technicals look strong. And as long as the market is staying relatively buoyant, it probably will work its way closer to that 280 level. So maybe I would take maybe a quarter off the table. And then if it's 280, take another quarter. And then keep a tight stop on it, because I do think it is overvalued at these levels. So I like your thinking, Art.
Also, due to the fact that UPS is supposed to strike by the end of the month, and I think a lot of people are going into the FedEx because, if UPS goes on strike, then next quarter is probably going to be a blowout quarter.
Yeah, exactly. And that UPS issue is probably only short term, and they'll only benefit short term. So you want to take that advantage of that to probably sell out of it. All right. Thanks for the call, Art. Now we're heading to a break. Give us a call now at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now, my focus point today looks in the story behind this question. Is it good news for investors if rates stay higher for longer? And we had the jobs number that came out on Friday, and it was right around expectations, 209,000 jobs, which is down from the 300 plus from the previous month and much lower than what we've seen lately. However, if you go back to pre-pandemic era between the middle of 2018 and the end of 2019, unemployment rate back then was under 4%, and the average amount of jobs created per month was only 155,000 jobs. So 209 is not terrible, right? And I've said this many times, that this is a very reversion to the mean type of economy. Yes, things are slowing down. Many parts of the economy are negative year over year, especially the goods economy. There's a lot of base effects built into these headline numbers that look sometimes bad, but a lot of it, if you go back more 2 years or even to pre-pandemic levels, it's more flattish to up, right? Where it's saying it's not to a level where it's not a recessionary level. Not at least your typical recessionary type of environment. And all that pertains to an environment where the Fed, is likely to stay higher for longer. And this could be an opportunity for you to add some income to your portfolio. The 2-year Treasury note finished this week right around 5%. And if you go even shorter, you can go to about 5.5%. Let me pull up the yield curve here. Yeah, if you go out 6 months, you're at 5.5%. 3 months, 5.5%. 1 month, 5.36%. 1 year is right around 5.25%. So the big question for investors is, will there be another stair step higher in interest rates? And the reality is, at least probably in the near term, probably not. And these level of interest rates haven't been seen since 2006, 2007 timeframe. So rates look attractive, even on a real basis, where the expected inflation rate going forward is about 2.2% over the next 5 years. Now, that's probably, honestly, too low. I think the market's pricing in too low of an inflation rate. So that's probably off, but it's probably not going to be 5.5%. And so even if the Fed raises a bit further, we're probably closer to the end of the current rate hiking cycle than the beginning. So yields on the short-term safe assets are pretty attractive. You can get 5.5%. That's pretty nice. Now, should you go out a little farther in duration? Maybe. I don't think you can go 10, 15, 20 years. I wouldn't go to the long end of the curve, but maybe short end of intermediate, going out 3 to 5 years. That's not bad. Especially if there's going to be a recession. There probably will be in the next 2-3 years, and locking in at north of 5%, maybe in corporates getting closer to 7%, that can be pretty attractive. So a lot of people get bearish when you talk about the Fed keeping rates higher for longer. I actually think that's bullish. Why? Because it's saying that the Fed sees the economy is fine. Things are holding together. I said this many times. A lot of people are worried about the inverted yield curve. It's not when the yield curve is inverted that you need to be worried. It's when it's inverted for an extended period of time, and then you get a bear steepener where short-term rates start to drop and the markets start to price in Fed rate hikes very soon. And that means, hey, the market's seeing that, yes, we are going into a significant economic downturn, and the Fed will be cutting rates. So I wanted to highlight that and give you some perspective on what signals the bond market is offering, as well as the opportunities. All right, let's go to James in New York, who wants to talk about CVS.
Yeah, I hold CVS, and I'm wondering if I might be time to maybe think about selling CVS. I don't know, is the strength still there, or are the days over where CVS is still reasonably worth $100, or is it just poised to move down?
No, I mean, it's already pulled back. A lot of this is a worry in regards to the health insurance industry. And I do think there is some worry there. But you have to remember with CVS, it's only about 30% of their revenue. So while, the UNHs of the world and the Humanas of the world, those are struggling in a big, big way because that's their entire business. The CVS has diversified a bit, right? They bought Aetna. And so that gives them some exposure there. But I think the market has punished them way too dramatically for, once again, the amount of their revenue coming from the insurance business. They still, get the majority of the revenue from their CVS drugstores and their pharmacies. And so we think this is an attractive area for CVS. And it's starting to gain a little strength as of late. Now, in the next Invest Talk, we look into the story behind this headline. Amid supply concerns, demand for lithium and other critical minerals are skyrocketing. Do investors have a play? We're going to get to that story tomorrow. But for now, I'm Justin Klein. I'm ready to take your questions live at 888-99-CHART.
The stock market is volatile. It's constantly changing. So how are you positioned? Is your portfolio properly balanced, or are you taking unnecessary risks? You can get guidance anytime for free if you go to InvestTalk.com and take the brief Riskalyze quiz.
Now, when people take the time to leave an Invest Talk podcast review on iTunes, we like to thank them for their courtesy by getting to their questions quickly. DBAJ says, if SPY eventually rebalances to other companies that go up in market cap more than the top weighted companies, then would it still be okay to buy the S&P index? Let me read that. If the S&P 500 eventually rebalances to other companies that go up in market cap more than the top, yeah, okay. So he's saying if the smaller names start outperforming those top weighted names. Isn't this what happened when Apple, Microsoft, Amazon, Google, etc., they gained size and the 2000 other companies previously dominated the SPY? The answer to your question is yes. You're going to get exposure to the names that rise up the ranks in market cap. But ultimately, that isn't necessarily a good thing. Think about that. It's saying that this is the kind of, I think, the flaw in the market cap weighted indices like the S&P is saying, okay, just if they're bigger, I'm buying more of them, right? I want a higher concentration of the highest valued companies in the world. Remember, when you're already worth trillions of dollars, how much more upside. It's very hard to double your valuation again, right? Before you're just drastically overvalued. Now, some can continue to kind of grind higher. Apple's a good example of that, where their business has stayed steady. They've been able to be a constant cash cow, and they've never really become drastically overvalued. But the other larger names, they absolutely are. So what you're saying is that you're going to be overweight all these mega cap names. Some of them might start to underperform. The Meta is a good example when it fell from grace. Was it last year, year before? And it's rallied since, but it's still well below its highs. And then you're saying that other companies, like maybe it's oil names, like it used to be in the early 2000s when Exxon was the largest component of the S&P. You're going to start buying more of those after they've already appreciated again. Does that really make sense? And this is why the equally weighted indices tend to work better. Because it's easier for those smaller names, even if they're still large cap, even if they're big companies, for them to double and triple than ones that are already some of the most expensive companies in the world. Right? So that's why mid cap, small cap indices, investments tend to outperform large caps over long periods of time because there's a lot more upside. There's more volatility, right? There's those bigger cap names are more likely to stay large, but what's their longer term performance going to be after they've already gotten there when now you're very overweight those particular companies? So I like your question, but hopefully that gave you an insight onto how these portfolios are constructed, these indices are constructed, and why those equal weight and those ones that are overweight the smaller names compared to the indexes, those tend to outperform long term. All right. Now let's talk a bit about, where are we? Let's talk about the legislation that is being negotiated right now in Paris. And this is actually on Monday and Tuesday. And now the politicians from about 143 different countries, these are tax officials from all these countries, and they're trying to negotiate a way for more equal taxing of the world's largest companies. And they're mainly focused on the top 100. And this would relocate the taxation of some $200 billion in corporate profits around the world. And most of these are tech names. Now, this is meant to let countries capture tax revenue from large companies really at the center of the information-based economy, who can operate worldwide and concentrate their profits in their home countries, or maybe they domicile in a low-tax jurisdiction like Ireland, for example, and pay little tax even though their users are not in those countries. Now, the worry here is these talks could collapse. There could be kind of a tit-for-tat tariff or special taxes levied on mainly American companies, because most of these tech companies, let's be real, are American companies. Now, the positive here is that there's a lot of agreements on the major components, but there's still a good amount of holdouts. Even countries like Canada, who are concerned about a lack of firm deadlines for implementation. But there's other countries, Pakistan, Sri Lanka, obviously Russia, Belarus, they oppose it. And there remains important issues to resolve, but they're getting closer. Now, this is building on the 2021 agreement that allowed governments to set a minimum tax rate for these companies. So they've already felt it a little bit, but this would go a lot further and update these rules that were really designed for an era when, in order to operate in a country, you had to actually put boots on the ground there, make substantive investment in there through distribution, manufacturing, sales, etc. Now you don't really have to do that. Think about it. If you launch an iPhone app, anybody who has an iPhone around the world can probably now download it. When you didn't have to put a dime into capturing those countries or those citizens in those countries. So this has been going on for a long time, and tech companies would likely pay less money to here in the U.S. and more to foreign governments, especially Europe. And Europe's the one really spearheading this because altogether their economy is much larger than ours, and they have obviously their citizens are using the vast majority of U.S.-based technology, and we're garnering the profits off of it. But there's also the pharmaceutical giants that book their profits in places like Ireland and Puerto Rico, and they're likely to pay more to the U.S., right, to the U.S. government under this deal as well. So I think from a tax perspective, it'll be neutral for the U.S. government mainly, but it will certainly decrease net profits overall, which could affect the market, especially the tech and the pharmaceutical space. Now let's pivot to the InvestTalk voice bank. This one came in earlier on 888.99 chart.
Hey, Steve. I was wanting to know your thoughts on Sibanye-Stillwater. SBSW is the ticker symbol. It's down to about $6 a share, pays a great dividend, but I don't know if I should buy more or if they are in a lot of financial trouble or why it's been going down. I know it's kind of a volatile area, but should I sell it and get out of it, or should I buy more? Thank you. Love your show. Bye.
All right, looking at Sibanye-Stillwater, SBSW is a symbol, and this is out of South Africa, and it's a gold miner. Now, they do have some other mining operations as well, but it's mainly mining gold, and that's what their profit is mainly sourced from. So it's going to be very volatile like most gold miners, but even more so because they're domiciled in Africa, which, as you probably know, is a jurisdiction that can be volatile, both from a political standpoint and from a jurisdictional standpoint, right? Dealing with local authorities, not just on the state level and dealing with wars and things like that. But, there's a lot of grift there. And many of these mines can be shut down because, hey, they want a bigger bribe. And so that's historically why their business is all over the place. And it is cheap, I will say that. So it's earn $1.45 next year on a $7 stock. So it's cheap. But it's cheaper than the market for a reason. So this is very high risk. This would be a very high risk way of playing gold. If that's what you want, this is your baby. And it just looks like it reversed, and I think it could have a big run. Just like the rest of the mining space. But once again, we'll have an outsized move, just like an outsized move to the downside, going from $12 all the way to $6, right? It's down 50% from its high in January. Whereas the GDX, the broad gold mining index, that peaked in January around 33 and bottomed at 28. So obviously a minor pullback. So it's a high risk way of getting exposure to a high risk sector. You have to be comfortable with that. If you want a safer name within the gold mining space, this is not it for you. You want to be going with one of the bigger names in more stable jurisdictions. Okay. Well, I don't know if you realize this. I know it's hot here in Laguna Beach, California, but this also means we are in the third quarter. And Steve and I have been telling you for a while now that we are in a new market environment, and serious investors need to adjust their thinking, their strategies to fit these times. And the last couple of weeks have been the hallmark of that. Starting to see the dollar break down again, starting to see value outperform after a counter trend rally for the first half of this year, where growth did outperform, but didn't make up the ground that it lost last year. Not nearly. So we're entering this new longer-term trend, where inflation, while coming down now, is likely to stay elevated longer term. Interest rates are likely on the rise. The dollar is likely to get weaker. which is very different than what we've seen post-financial crisis. So it's about zooming out and seeing the big picture. And if you need help seeing the forest through the trees, I encourage you to reach out to myself or Steve Peasley at our company, KPP Financial, where we practice parallel investing. And we provide unbiased guidance, both on and off air. So you can schedule a call with me via telephone or GoToMeeting. You can do that through our website, investtalk.com, or you can give our KPP Financial office a call in Irvine, California at 800-557-5461. We'd love to help you, and the sooner you get in touch, the sooner we can help you get your portfolio optimized. Now, next up, another caller question for you, so hang on.
In today's world, a variety of factors are affecting the stock markets. Serious investors know building a secure financial future requires hard work and determination. That's why now, more than ever, when it comes to the planning, execution, and maintenance of your portfolio, you need InvestTalk. InvestTalk is a free download. Your participation makes it unique. Don't forget to call InvestTalk 888-99-CHART.
Hey, Justin and Steve, this is John from New York. I'm calling with regards to the WP Carey, WPC. They've dropped around 20% since late last year, and they're at their lowest since about 2010. They have a strong dividend. Is this a good entry point at around $67? And is their dividend sustainable? I'm not sure about the growth aspect either, so if you could touch on that. I'm looking forward to hearing your response. Thank you so much.
All right, this is WP Carey, and this is one of the largest, well-diversified REITs out there, about a $15 billion market cap. And what's interesting about this name is that it's not just diversified across different types of real estate properties, but also geographically. It has a lot of properties here in the U.S., Western and Northern Europe as well, and it has offices, single tenant office, industrial warehouses, retail facilities. And while most of the company's revenues come from properties here in the U.S., once again, it is well diversified. A lot of the leases in Europe are inflation adjusted, so there's some inflation protection there, which is good. And it has come down, but it's still a very well-run REIT. So I like the diversity here. I like the value that you're getting here. Obviously, there's a bit of a worry on the office side, and that's going to hang over the REIT sector as a whole. But I like that WP Carey has a long history of operations, so it can remain nimble. It has other properties that are going to perform maybe when office is not. And so if you're looking to just get exposure to a good operator, global real estate exposure, this would be a solid name, to be honest with you. And it is at, let me pull back here. Yeah, it is at pretty good support down here around 66. So I'm going to give WP Carey a modest thumbs up. Obviously, I don't love the office exposure, but I like the diversity of their business. All right. Thanks for the call. Now, I want to remind you that this is a time where you probably need some guidance, and you're tuning in to try to get our view of the markets, and we only have an hour here, and sometimes the way I distill each day can be maybe not enough time. And so our premium newsletter is a great tool for especially newer investors trying to learn some things, right? Learn how to analyze the market, learn what the economic numbers mean, learn how to manage a portfolio, maybe get an idea of what are good companies to be at least looking at. Maybe you don't buy it today, but you should always have a watch list of companies that, hey, these are interesting, these have good businesses, and if they get the right price, maybe I should buy them. Okay, so our newsletter is a great tool for that. Now, this is Invest Talk. I'm Justin Klein, and we have one goal here. It's to help you achieve your own version of financial freedom, and our work continues after this final break. So get your questions in now at 888-99-CHART.
No two portfolios are alike, and every investor has a unique set of circumstances. So don't forget to call InvestTalk. 888-99-CHART.
Hey, Steve and Justin. Just calling because I wanted to know you guys' take on the ETF SPSM. It's a small cap ETF. Just wanted to know for the long-term hold. I have a small position in it and want to know what you guys think about it. Thank you.
This is SPSM. This is the Spider Portfolio S&P 600 small cap ETF. And it's basically an index fund, index of the S&P 600 index, 600 different names. Now, this is different than the Russell 2000. So, do you want to own the Russell 2000, which versus the Russell 600? The S&P 600, both are small cap. I'd have to really do a deeper dive to decipher between the two because I don't know a whole lot about the S&P 600, except that I know it's a small cap index. So you're indexing, it's good exposure to small cap. I would just try to do a deeper dive and figure out whether this is better than the IWM, which is once again the Russell 2000, also small cap, but a little bit different flavor here. Let me look at this portfolio real quick. Yeah, they're very similar, but you're getting more diversification, which isn't necessarily better with the IWM. I would actually look more at the sector weighting, 16% in industrials for the IWM. The S&P 600 is about 17%, so a little bit better there. And if they go side by side, it'd take a little time, but it's a fine ETF if you're just trying to index. All right, thanks for the call. Now, speaking of that, let's touch on these ETFs. That's a good segue here. And what's interesting is that the 50 stocks in the S&P 500 that fell the most last year lost an average of 31%. And then those 50 stocks rebounded by about 56% this year. Now, I haven't done the math, but it means that probably most of them are still not to the high. That's how that math works. But and simply buying the losers last year was a good strategy so far, but that's not usually the case. Okay. Now, contrarian investors don't usually just buy what fell the most. What they usually do is they try to find companies that are undervalued. That's what we do at KPP. This is called value investing. And the whole growth versus value, we talk about it a lot, but the difference in the performance became much starker post-financial crisis, mainly because the longer-term trends were kind of bucked, meaning for a long period of time, growth outperformed value for the longest period since pre-1929. The last time growth had that much of a winning streak above value was the 1920s. And so this discussion is pretty interesting. But what's interesting about these ETFs that you're seeing in the marketplace, the value ETF, the growth ETFs, is that you still have to understand what value means to the index constructors. For example, the S&P. Now, there's the S&P 500 value and there's the S&P 500 growth index. And you might be surprised to know that the biggest holding within the S&P 500 value index is Microsoft. And you say, isn't Microsoft more of a growth stock based on the multiples it's trading at? And the answer is probably yes. But according to the S&P 500, or the S&P, it's not quite a growth stock. So if it's not a growth stock, it has to be a value stock. It's got to be one or the other. And that's what's made the S&P 500 value ETF outperform something like the CRISPR value index this year because it just holds Microsoft as its biggest holding. And so I wanted to highlight this because you don't always get what the title of the fund says it is. That's why it's really important to go dig into the holdings. Guess what? You can find that on their website. You can find that on Morningstar. You can find the constituents of the ETF that you're holding, understand the weightings of the sectors that you're in when you're buying that. Never buy a fund simply based off its name. Understand the constituents, and the overall strategy that's employing, so that you know that there's not style drift away from what you really want. Okay? I'm Justin Klein. This completes another InvestTalk program. Steve and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can get anytime at iTunes, Spotify, or Google Play. And it's official. We've now surpassed the 53.9 million download mark since it all began. So quickly approaching that 55 million mark, all thanks to you. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights.